advisable to go ahead or not. We have spoken about break-even point, contribution, fixed cost. What if there is sales beyond break-even point, and we know that is going to give us profit? So that portion of sales beyond break-even point, that means we have recovered all our expenses, all our variable, fixed, and everything. So every further revenue from there minus the variable contribution, variable past, every further contribution from there is a direct profit for me. In a realistic scenario, that portion of sales is called margin of safety. Let's take a look at an example. Sales is 1 lakh. Variable cost given is 40,000. Fixed cost is 30,000. Okay, understand the question well. Total sales is 1 lakh. Variable cost is 40,000. Fixed cost is 30,000. Okay. So this is all what is given. Let's say we need to find break-even point. Sales is 1 lakh. Variable cost is 40,000. What do? Sales minus variable cost, which is 60,000. That is the contribution. That contribution, fixed cost divided by contribution, is the number of BEP in units. We haven't got per unit number here. There is no per sales price per unit. There is no variable cost per unit. There is no information given with respect to quantity, right? So BEP units we cannot find out. We can find BEP sales. How? 1 lakh minus 40,000, which is 60,000, is the contribution. 60,000, 30,000 divided by 60,000, which will be 50%. 50% of sales will be what? 50,000 will be your break-even point sales. And repeat. Sales minus variable cost, 1 lakh minus 40,000, that is 60,000. Fixed cost 30,000. 30,000 divided by 60,000, which is 0.5. In percentage terms, 50%. 50% of sales, that will be equal to BEP sales, break-even point sales. Let's test if this is true, right? In the same question, there were 100 units produced. Okay, this is the additional information that now we have with us. So the variable cost per unit is 40,000 divided by 100. That is 400. And our sales price per unit, 1 lakh is the sales value, divided by 100 is 1,000. What is contribution? 600. What is break-even point? 30,000 divided by 600 is 50 units. 50 into 1,000 is what? 50,000. What did I say in the previous computation? 1 lakh minus 40,000, that is 60,000. 30,000 divided by 60,000, 50%. 50% of 1 lakh is equal to 50,000 as the BEP sales. We have figured it out by adopting 100 rupee, by knowing 100 units that were produced. We arrived at variable cost per unit, sales price per unit, arrived contribution per unit, and then arrived BEP units. BEP units into sales price is equal to BEP sales. So that comes to the same 50,000 that we have arrived at. Let's look at how profit is computed in the same equation, right? Contribution, we know it is 1 lakh minus 40,000. This is equal to 60,000. Contribution to sales, we know that is 60,000 divided by 1 lakh, that is 60%. So what is profit? Profit is equal to 1 lakh minus variable cost, that is 40,000, minus 30,000, which is fixed cost. What is your profit? Your profit in this case is equal to 30,000. In other words, if you were to consider contribution, that is 60,000, minus only fixed cost. That will also give you the profit. So that is clear, right? Let's take a look at what is margin of safety. Margin of safety is sales minus break-even point. We have already spoken about it. When you have sales more than the break-even point sales, is margin of safety, as the word indicates. In this example, break-even point sales is equal to 50 into 1000, 50,000, right? But what is the actual sales? Actual sales is equal to 1 lakh. So margin of safety is equal to 1 lakh minus 50,000. That is 50,000 INR and 50 units is the safety margin they have, right? In this illustration, you've learned break-even point, you've learned contribution, break-even point, how to compute profit, and how to look at what is the margin of safety. There's another way to compute profit. Margin of safety minus variable cost is equal to profit. Get this concept very clear. Because margin of safety is applicable only when you've crossed break-even point. At break-even point, you've already recovered all your fixed cost. So for the part of margin of safety, all what you have to worry about is the variable cost, right? So when this margin of safety sales figure is given, if you straight away reduce variable cost, you will get profit. In other words, margin of safety is sales after break-even point, which means the entire fixed cost is already recovered. For margin of safety part of sales, there is only variable cost. So we don't have to reduce any fixed cost. We reduce that, we get profit. Let's take a look at this example. In this example, our margin of safety is 50,000. We just reduce our variable cost, which is, what was our variable cost per unit? 400 per unit. 400 per unit into 50 units. That is the margin of safety unit. That is 20,000. So we get the profit. You want to check this again? Take a look at this. Contribution was 60,000. Contribution to sales was 60%. Profit was 30,000. Let's take a look at what was the unit cost also. Your variable cost is 400 per unit. BEP was 50 units. And therefore, our margin of safety in units was 50. Okay? So when we compute this, 50,000, which is the margin of safety in value, 50 units into sales value is 50,000. 50 units into 400 is 20,000 minus 50,000 minus 20,000, you get the same profit value. Let's move on to a little more complicated but very, very important part of marginal costing. Profit volume ratio or contribution to sales ratio. In examination questions, usually you are given with PV ratios, which is profit volume ratios, and then asked to find what is the sales, right? As the name indicates, this is relevant when there are two volumes given, two point in time, there are different point in time, different volumes of production and different cost numbers are available. When different volume of production and different cost numbers are given, naturally contribution and the other cost elements will change. The trick here is, once the PV ratio is given for different point in time, can you find out the variable cost, and therefore can you look at fixed cost and then later arrive at sales. So when a PV ratio is given and we are asked to find out sales or total cost or profit, we can use in mathematical formulas to reconcile, right? We know fundamental equations, which is sales minus variable cost is equal to contribution. Contribution divided by sales is equal to contribution sales ratio. We know fixed plus variable cost is equal to total cost. We know sales minus total cost is equal to profit. So when all these fundamental equations are completely known, we can use these ratios given for different point in time to arrive at any of the missing information. Concept-wise, this ratio is applicable when total sales and cost data is given at different production levels, right? It can be different point in time or different production levels. PV ratio works on the basis of these facts. Once we get this very clear into your mind, every problem will be very easy to solve. Variable cost per unit does not change as per production levels. We've spoken about this at the beginning of the chapter. Variable cost per unit does not change. That is why it is called variable cost. If you need 1 liter petrol to travel 10 kilometers, 20 kilometers, you need 22 liters of petrol. 30 kilometers, you need 3 liters of petrol. That doesn't come down, right? So the variable cost per unit does not change as per production levels. Total variable cost changes in directly proportionate to the volume. Total fixed cost does not change as per the production volume. Like the car rental, if you're taking a car on rent, petrol cost will increase more kilometers you go, but the rental doesn't change. EMI doesn't change. That fixed cost does not change as per the consumption, as per the volume. Fixed cost per unit changes as per the volume. Assuming your car rental is 10,000 and you drive 100 kilometers, per kilometer car rental will be now 100. Instead, if you drive 1,000 kilometers, per kilometer car rental is now 10 rupees. So fixed cost per unit will change, but total fixed cost will not change. Let's recap. Variable cost per unit does not change. Total variable cost changes. Total fixed cost does not change. Fixed cost per unit change. These are fundamental aspects of how PV ratio works in solving examination questions and also real life questions. What would this mean? This would mean contribution per unit does not change as per the volume of production. Why? Because in contribution, we consider only variable cost. Sales price is constant, variable price is constant, and therefore the contribution per product also will remain constant. What is the equation for arriving at profit volume ratio? Profit volume ratio, or in other words, contribution to sales ratio, is calculated by dividing contribution with sales into 100. Contribution by sales into 100. That is profit volume ratio. Another word of, if you just keep in mind contribution to sales ratio as the synonym, as the other word of profit volume ratio, this equation will naturally come to your mind. Only because we call it profit volume ratio, we think it is something different. It is basically contribution to sales ratio. Contribution divided by sales into 100. Another way to compute profit volume ratio, when there are two levels of production given or two types of activity given, and we have not been given these inputs. Contribution is not given, sales is not given, then either of that is not given, or or let's say one of this is not given. In such a scenario, we need to arrive at change in contribution or change in profit, and then divide by the incremental sales or the difference sales. The sales is the total sales here into 100. We will get profit volume ratio. Let me explain. Let's say product A, at a particular point in time, we produced 100 units of product A, and we managed to get 1,000 rupees of sale contribution. Another point in time, you produced 500 units of product A, and we managed to get 5,000 rupees in contribution, right? And there is no other information given. How do we arrive at the number of units that were produced, or how do we arrive at the profit figure? We can quickly look at the difference between two production levels, like 100 units, it was 1,000. 500 units, it is 5,000. That means the difference is 400 units. When 400 units of difference in volume happened, the contribution has increased by what? 4,000, which means per unit contribution now is how much? 10 rupee. Because your per unit contribution is 10, and per sales, incremental sales, that 4,000 divided by your incremental sales is 400 is 10 into 100, right? 10% is the profit volume ratio. This equation, all the informations are given. Therefore, we are unable to recognize how is this helping us to solve a problem. We will come to solving a problem a little sooner. Please get this equation very clearly in your mind. Profit volume ratio is equal to change in contribution divided by profit. Sorry, my mistake. Change in contribution or change in profit divided by sales into 100. That is profit volume ratio. This equation helps us to find missing information from any given scenario. There's another fundamental equation. There are two fundamental equations that one need to keep in mind. Contribution is equal to sales into profit volume ratio. Because, in other words, contribution to sales ratio is what we say profit volume ratio is. So, if contribution is not given, profit volume ratio is given, sales is given, we can find a contribution by multiplying sales into profit volume ratio, right? Therefore, if sales is not given, contribution is given, profit volume ratio is given, what we can do is contribution divided by profit volume ratio. That will give us sales. These are mathematical equation aspects, how this equation will help us find missing information, right? Let's take a recap. First equation we've learned, profit volume ratio or contribution to sales ratio is equal to contribution divided by sales into 100. And profit volume ratio could also be change in contribution or change in profit divided by change in sales into 100. Given with these equations, we can find a contribution in a scenario where sales and profit volume ratio is given. We can simply multiply sales into profit volume ratio and we can arrive at the contribution. Similarly, sales is not given, but contribution and profit volume ratio is given. We can divide contribution by profit volume ratio and arrive at sales. I shall repeat. When sales and profit volume ratio is given, multiply sales with profit volume ratio, you will get contribution. When contribution and profit volume ratio is given, divide contribution by profit volume ratio, you will get sales.